Good morning, everybody. Welcome to the Flow Show. Hope you're all doing well this week. Morning, Kay. Morning, Stell. How you doing, lads?
Morning. Yeah, all good, mate.
Hello.
Everyone have a good weekend?
Yeah, very good. Very
okay,
good.
then. Weekend's all right, is it?
Do you want to know? I was on a little Greek island close to where I live, so.
No, that's it. I'm not asking about weekends again. Don't give over. So nothing but rain here all weekend. And I've packed the kids off they've gone to a scout camp yesterday, and it's done nothing but rain ever since they've got there, and strong winds and everything. So haven't heard a peep from them, and don't know what they're up to. They could all be blown away for all I know. But I'll find out on Thursday whether they enjoyed it or not. Anyway, right, let's get cracking. Lots to go over this week. Every week there's lots to go over. We had a busy week last week, got a busy week of data this week.
Gonna be a busy one, yes, this week, mate.
Another busy one. And then we're probably going to see the summer lull kicking in. So enjoy it while it lasts. So to kick off, China further announcing plans to enhance financial support for consumption. They're going to expand consumption in new electric vehicles. This is something that they've been banging on about for a while. But again, they're pushing forward with new measures. Again, fairly light on the details, but China press saying that this is all going to be coming up very shortly and put in play very shortly. So further moves to get the consumer spending over there in China. Now, we've already had a ton of data out this morning. As you can see, I'm not ready. So let's get back to there. So everything that's come out overnight this morning in Japan, we're going to kick off with industrial production coming in at 2% versus 2.4 expected. So not as high as expected, but still positive over last month. Retail sales as well, coming in at 4%, unchanged over last month. Month-on-month sales were down 0.4% though, versus down 0.7 expected. So a little bit better than expected, but still a negative number. Consumer confidence, I'm not sure where this is showing up on here. Some of these calendars carry it, some of these don't. Yet there we go. Household confidence coming in better, 37.1. So the consumer feeling a little bit better over there. However, housing sector not looking as good. Housing starts year on year down 4.8%, a bigger drop than expected over there. Keeping to the BOJ, they released their quarterly report, and the top line from that was that core consumer inflation is likely to gradually slow towards the year end, but it is likely to accelerate after, although that outlook is uncertain. So they must be vigilant to the fact price hikes have spread rapidly among firms and sectors that have previously been cautious of raising prices. So that's a nod to that core inflation. They must keep an eye on whether price hikes to pass on those costs persist and broaden further. More firms are becoming open to raising wages, and they must scrutinise whether and how this will affect price developments. So a little bit of caution there from the Bank of Japan, highlighting that there is inflation pressures. Are they going to continue? Are they going to increase, or are they going to fall back and then not increase after? So pretty much the party line from what we heard from the BOJ last week as well. Now they did step in this morning, and I've seen a few headlines about. One of the main headlines, they offered to buy 300 billion in 5 to 10 year JGBs, part of the slowing process of what we've seen in the 10-year JGBs since their action last week. As you can see, we're knocking up at 0.6%, so already we're above the soft 0.5% boundary. So it looks like they're in slowing. But as I said, I've heard that they were in some other bonds. I heard that one headline said that they were also in unlimited. So I'm not sure whether they just coming in small pieces just to do a bit of smoothing there. Politicians, one of the politicians isn't too happy about the BOJ's decision. Senior LDP official Seiko said that the BOJ decision could throw cold water on the Japanese economy and it needs high attention. And that gives you some idea of the nature of Japan. You know, a little YCC tweak and there's some thinking it could completely destroy the Japanese economy and the strength it's seen. I'm not sure that's the case, but we shall see. That's one thing they'll be very cautious about. There has been a little bit of a change at the Bank of Japan in some of the, let's call it the backroom staff. They've appointed Kazuhiro Masaki as their new man to oversee the monetary policy framework, the review that they've been talking about. He was previously head of the bank's financial system department, which included, and he was involved in some of the big shifts in Bank of Japan policy, negative interest rates and yield curve control. So he's stepped up to head this review, if you like, of what's going on at the Bank of Japan. Kate, anything you want to pick out from the Japanese stuff so far?
No, mate. I mean, we can talk about prices later, but no, I think Bank of Japan did a good job in slowing and signaling a change, but then doing it like in a way not to disrupt markets, and they've already been in the market. I think the fixed rate offers to buy JGB Unlimited is perhaps above the market also. I don't think they went to really market rates on that one. And then yeah, the Japanese LDP officials already say like, hey, don't let rates go too high because we need to fund all those stimulus packages. No, I'm not seeing anything specific on those things. And the data, yeah, those industrial production data, they always are very optimistic on what should come out the month after. But then usually we see a bit of a setback on those expectations. On the other hand, what were the other numbers you talked about?
Retail, consumer confidence.
Yeah, the consumer confidence was all right, right? Yeah, I mean, for as long as they are not going to let the whole thing go, I don't think there's too much to read in those data. And the housing starts, we have to know that there's not that much for sale or changing hands percentage-wise compared to other major countries. So I tend not to pay too much attention to those numbers.
Yeah.
That's on the data front. Then the market seemingly buys the slow and smooth change in the Bank of Japan, because we reversed and more all the pre-BOJ and BOJ moves.
Yeah,
pretty spectacular actually on the cross-yen front.
Yeah, which we'll look at shortly, of course. But just continue with some of the other data, because there was a ton out. As you can see there, Chinese PMIs coming in there as well. A little better on the manufacturing, if you can call that an improvement, to 49.3 from 49.2. That keeps them in contraction. But services going the other way, 51.5, so another setback there. Was expected coming at 52.9, so much worse than expected number, and obviously a big drop over last month. Price data, as you see there from Germany, more negatives and increasingly larger negatives coming in now. Minus 1.6% on the month, minus 11.4% year on year. Retail sales coming in minus 0.8% in Germany, down 1.6% year on year. Not as much as expected, but still another negative print. So lots of minus numbers coming in for Germany. I'm still surprised they managed to print a flat number for their GDP after seeing some of this data, but maybe obviously they estimate a lot of stuff, and this sort of information will be falling into it as well. So maybe we're going to get revisions downward in the next numbers. Italy GDP coming in missing expectations, down 0.3%, year on year 0.6%. So not looking as hot as the others were, France particularly last week, and indeed Spain as well. So a negative there for Italy. Further numbers, Bank of England numbers as well, BOE consumer credit and mortgage data. Mortgage approvals looked had a healthy jump, 54,500 versus 49,000 expected. But the mortgage lending, total mortgage lending wasn't up. Usually you might see that much higher based on that number of applications. So only came at 0.14 billion versus 0.10 billion expected, which suggests that mortgages are being renewed rather than new ones putting on, because when you renew a mortgage, it's for the same or lesser amount. So it doesn't increase the lending numbers per se. So that suggests we are getting a lot of people remortgaging, trying to lock in rates before they jump higher, or those coming into ends of deals having to lock in at higher rates. Consumer credit overall, you can see there 1.661 billion. This is a number I watch closely to see if there's any pressures coming in from individuals. Of that number, there was 600 million put on the credit cards, which was unchanged over last month. Credit cards numbers I look at to see if there are any stresses. If people are not getting normal loans, if they're running short of money, they tend to put it on the plastic. So if you see a big jump in people using credit cards, it suggests that there may be some issues, but nothing of note from there. There were obviously the other 1 billion jump in borrowing is down to personal loans and a lot of car dealership loans to buy cars. Now, this is a thing that's going on in the UK at the moment. Lots of people are changing up their cars because of emission rules and emission zones being put in place and extended around the country. It's led to a lot of people changing up their cars. I've changed up both my cars in the last year. So I've known plenty of other people as well, family as well. So there's been a big jump in lending of those. Now, the problem is all these new loans coming in are coming in at much higher rates, obviously, because of rate rises. So although people are maybe making a big purchase now, we've got to see whether that puts a squeeze on spending further down the line. If it means discretionary spending might take a bit of a hit because you've just lumped out for a car, got a big loan, high interest rate, you're going to be putting a lot of money into that, especially if you're paying off a mortgage now at higher rates. So going to be keeping an eye on those consumer retail sales numbers coming in over the next few months, just to see if it's putting a bit of a squeeze on. But overall, as far as credit card spending goes, nothing, no red flags from that one. CPI coming in as well. Italy CPI coming in just a bit lower than expected, confirming a drop from last month. Also the same on the HICP number. Just again seeing some negative numbers coming in there, more than expected on the month. Greek retail sales down 0.4%. You're not spending enough still on your holidays.
Yeah, I don't know.
Well, mind you, it was last month you went on holiday, so that should bounce next month. So yeah, get out and get spending, mate. Stop buying old cars and buy some new cars. In the Eurozone, core CPI, surprisingly coming in a pip over expectations, the same as last month. That sticky core number remains in play in the Eurozone. CPI dropping as expected 2 pips to 5.3%. GDP pretty much reflecting what we've seen already. Some positive numbers, a bit better than expected, say like we saw from France, Spain, etc. So on the quarter, 0.3%, year on year, 0.2%. You know, these numbers aren't going gangbusters. And Lagarde was out saying over the weekend that the second quarter GDP numbers for France, Germany and Spain are quite encouraging. And she thinks it pushes them towards their expected whopping 0.9% GDP this year in the Eurozone. That's what's expected, very low numbers, nothing booming going on there. Other ECB speakers as well. Villeroy says our growing confidence in the fall in inflation towards 2% is based on the good transmission of monetary policy. Perseverance is now the prime key virtue, given the time needed for that full transmission of monetary policy. Pragmatism also needed, as decisions at upcoming rate meetings will be open and entirely data driven. ECB's Nagel, maybe one of the last holdout hawks, along with Casimir, says we need rates to be high enough and keep them there as long as necessary. So she wants to, or he wants to keep rates up, and potentially might be leaning towards a September hike as well. Right, coming back to good old US of A last week on Friday, we obviously got a ton of data out. PCE data coming in softer than expected. Core PCE 4.1% versus 4.6% previously. The PCE also coming in 3% versus 3.1 expected and 3.8 prior. Now, I was thinking this might come in lower than expected, as I mentioned, after the GDP numbers the day before, which include estimations for the June PCE. And we saw, obviously, in those GDP numbers, much lower PCE numbers. So no surprise to see that coming in much softer. Also looking at something that Powell pointed out, the employment cost index on things like wages, and now this apparently has dropped to the lowest in a couple of years, or this gain has dropped to the lowest in a couple of years. Missed expectations 1%, and wages missed expectations as well, 1% versus 1.2 prior. So wages, or these costs, are still rising, not as much as they were previously, which potentially takes some heat out of the inflation trade as well. Means inflation could keep going the right way, but remaining positive is also positive for the economy in terms of costs. It means people are getting paid more, and that can help with things like consumer spending. So we're still soft landing mode in the US. Canada GDP coming in on the month as expected. Not sure what that one is. I can't remember what that one is. I think that might be the rolling number, but the month-on-month number coming in at 0.3%. Year on year came in at 1.9% as expected, but higher than the previous 1.7% year on year. So nothing to worry about over there in Canada. The Michigan data as well, a little bit of a pullback in some of the numbers there. As you can see, a point pulling back to 71.6. This had a big jump, as you can see, over last month. So probably shouldn't be too surprised with a little bit of a pullback in the revision. That 5-year inflation number came back down again to what it was last month, 3%. But the 1-year inflation expectations held at 3.4% on that one. So still more soft landing data. The other thing I've got on the docket is that Ben Bernanke, the old Fed chairman, is now going to lead a review into forecasting at the Bank of England. They've got that desperate in the fact that they can't predict the sun coming up in the morning. They're getting in Ben Bernanke to come and have a crack at doing it.
It's a good move, because every problem is going to be contained, right? That's what they're going to say. Oh, it's contained.
Yeah.
That's our forecast.
I'm just happy because I can open my old picture vault of all the Bernanke photos that I used to use when he was in charge, so I can start throwing them up again if he starts knocking some comments around. So I'm looking forward to that. Anyway, right, done is done on that front. So let's have a quick look at what's coming up. Quick overview of what's coming up this week. As mentioned, a busy week. So we have most of the data. The old Chicago PMI coming in at 2:45 this afternoon. Keep an eye on that from 2 minutes into the number, because that number gets released to subscribers 2 minutes before the rest of us peasants get it. So if you see a sudden move in dollar pairs, it usually means that there's been a big variation, and you'll get an idea, obviously, which way that variation has gone, depending on which way the dollar moves. So that's one to always keep an eye on for that. Tomorrow we start getting the final manufacturing numbers from the Eurozone and the US, and also the big ISM number coming in as well. Also the RBA coming in the early hours of the morning as well. So that's a bit of a fence sitting number, or a bit of a coin toss for that one over what they'll do. Rate probabilities are around 78–80% that they stay unchanged over that decision. But will they hike? Will they not? It's a bit of an open question these days. Wednesday, we start getting the employment data coming in with the ADP number. Let's see if they can predict what's going to happen again this month. Obviously, Friday's NFP numbers. Thursday, we start getting the rest of the final PMIs, services and whatnot, and also the Bank of England. This one will just be a meeting, not a meeting with forecasts. Or is it August? Is it a meeting with forecasts? I can't remember. I'll have to check that one. Might be an NPR report. I'll double check that one. But otherwise, yeah, US data as well. Services coming in with the ISM later on Thursday. Friday, we end up with a big one, NFP and double bubble with Canadian jobs as well. So lots to get our teeth stuck into this week. So let's have a quick look at the prices and what's been going on in markets. I'm going to leave Kate to do dollar yen when I hand over. I'm going to take a look at euro sterling, which had a little look down towards the 85.5 level. I was hoping we'd get a bit of a move further under there, maybe down to 20s, that sort of thing, down to this prior area, just to add to my longs. But looks like we're going to see some sideways action. The Bank of England might get me some of that, depending on their announcement. Early thoughts of the Bank of England is it's a bit of a coin toss again, whether they go 50 or 25. I think if they go 25, they'll leave the door open for another one. If they go 50, that'll likely be it. So it just depends on how they sell whatever hike they go ahead. But the market is expecting them to hike. Current probabilities are 66% of a 25 pip hike, and the balance 34% for a 50. So 25 pip edging it for that. So I'm going to be looking at euro sterling this week in particular, for my current longs, and to see whether we get another move down to 85 level and what happens down there. Looking at some of the other pairs, dollar China, still keep an eye on that one. We're finding a few bounces off the lows here, but again, the bounces are looking pretty weak. I'm not too encouraged by this one still at the moment in terms of seeing further upside. I just don't want to sell it here. That's the problem. I'm not keen on buying it. I'm not keen on selling it. I want to see a bit more development. It is holding this 711, 712 area, but if we get another test of that, it could be that we're going to be breaking it just on the basis we've just made that new low last week. And as I say, the bounces are pretty weak. So price action suggests that we're heading lower before we're heading higher. But we'll have to wait and see what happens with that one. Certainly they're continuing easing in China, so nothing changing over there. And we have to see what's happening in the dollar. Now, this hasn't followed up what's gone on in the dollar elsewhere, particularly dollar yen. And so I'll let Kay have a look at that one in a moment. Yen is pretty much the story going on today. Kay, do you want to take it and have a little look?
Right now, yeah?
Yeah, go, mate.
Okay. Right. Well, just because we had a bit of an issue with our chart providers this morning, so I hope everything is okay there. So yeah, on Friday I said, like, look, watch this cloud, right? We did top and bottom of the cloud actually twice on Friday post Bank of Japan, and now we are back. We're back well above the bottom of the cloud. Today lies around 141.10, 15. We're already a big figure above. What's really impressive this morning is the rejection of those lows and yen strength, not only in dollar yen, but if one looks at all the crosses yen, they are very impressive. I think the market really was positioned and was expecting or hoping rather the Bank of Japan to do much more, but they have been disappointed by the move of the Bank of Japan, and perhaps disappointment. If you look at the longer term players, they are not going to be too disappointed, because somewhere one could argue as well that the Bank of Japan did a pretty good job in going only gradually and not letting any market disruption set in. On the other hand, what it did is that it created a situation where if the Bank of Japan only lets this 10-year JGB go up to 1% very slowly, and on Friday I was saying that it's perhaps their aim of letting it go to 1% or close to 1% into the next Bank of Japan meeting, which is nearly 2 months away or a month and a half away. I don't recall exactly what date. I think 18th or so of September, if I'm not mistaken, is the next Bank of Japan date. I've got the impression that they will let it go very slowly up to that 1% then, and then we may have the situation where they start to move a little bit the real interest rates, which are still at minus 10 bps, so negative, to at least go flat or slightly into positive perhaps. So what I'm expecting in the long run is that we have to look at what's happening on the other side of yen pairs, and that is the dollar, the euro, and the other currencies. If you look at the commodities, if you look at oils, they are going trying, well, at different speeds, but oils are trying to go up, and those currencies will likely get bought again against the yen right now. Is it a blind yen selling? I wouldn't know, but I'm going to be a little cautious. I do think the yen in a first leg could weaken again, because, as I said, there's still a lot of interest rate differentials with other economies and other countries. So it's very tough to stay long yen for long, because you're going to pay at least 2.5, 3.5, and even more if you look at the carry trades, much more away when you're long yen. So if you're long yen, you need a fast move, otherwise funding will start to bite. And we are again in that situation because the Bank of Japan is keeping things slow. So dollar yen, yeah, watch this first thing, and then on the top side, there's a bit of resistance around 142.5. But the big one, and that we will see how it develops. But you know how this market can go fast. As I said, I had a bit of an issue with my charts this morning, but there's a big level at 145, as we know from prior tests up there, as we know from expectations as well from the Japanese local players, saying that the MOF may not be very happy if we trade up at 145. And then we come again into this question that we heard from Kuroda at the end of last year when they intervened, or the middle of last year, saying that any 200-300 pips move in dollar yen are fast and could be disruptive. So are we going to be in this scenario again? They will probably, if they are, they might disregard this big Bank of Japan move, but and have a look at 140 or 141 perhaps. So, but we are already trading 200 and odd points above 140. Add another 1 or 2 days and a move back up to 145. I would expect the Ministry of Finance, bots, Suzuki, etc., or Kanda starting to come on the wires again and tell the market to be very, very careful. Perhaps if we see such a move, it may be also telling the Bank of Japan that they can let those yields go a little bit more rapid. So if we see this move, I would be very careful, okay? On the other hand, I don't see too much that is going to put the dollar yen much lower because of those interest rate differentials. And we all know that economic data only means so much when you talk about the yen. There's a lot more going on in yen than just economic data. On the underside, of course, we are going to look back at these 138, 137.5 is now an even bigger level. Okay, so in the medium term, if ever we start to get there or even break it, that's going to be really the end of the story for now, and then we are going much lower. But for the time being, I'd say it's going to be a deep buying on this dollar yen or even yen crosses. You know, quick. Let's just have a quick look at the yen crosses. Look at this rebound of the euro yen. We're already back at 157. We know the double top around 158 or triple top. Even keep a very close eye on that one to see what's going to happen. And look at the 155. You know, on Friday we started to get up there. We hang around for a little bit, and that's exactly we retested it early Japan, and that's exactly where we took off from. So your 155 in euro yen is still going to be a very big move, and then a very big level. And the last one I wanted to keep to show you again. Those carry trades, right? Yeah, there, as you can see, I'm having still an issue there on my charts. We're back at this 850 on the MEX yen. So for as long as those carry trades are not going to show weakness or the market continuing to hang around what we call correction levels also, and then start to grow, we are still not at the end of the carry trades. Speaking about MEX though, we are having two relatively important days today and tomorrow. We are going to have the Mexican GDP out, second quarter GDP, and tomorrow we have the PMIs out, manufacturing PMIs. We know that the Mexico is a manufacturer for the US now as well, and for people wanting to turn their back to China. So I think for the MEX, we are going to have a couple of interesting days right now at the start of this week. Will it impact a lot on this MEX yen? I don't know. For it to really start to turn around, we have to get back below this level, which is about 3 to 4% lower than where we are now. And if we start to break below 8 on the MEX yen, then I would say like red alert, okay? This is going to be a big level. So that for that, on the yen, I haven't really looked too much in detail on the commodity yens, but it's just the same pictures everywhere. Oh, Aussie yen, perhaps an interesting zone here coming up. Yeah, around 95.5. We are not that far. We're trading 95.30, 95.5 confirmed through 95.65. There may be another leg coming. That one is going to be a mover tomorrow, right? The RBA. And speaking about the RBA, it's a flip the coin for what they will do. Keep the rate still or hike again. There is a case for hiking them. We've seen the CPI be stubborn. We've seen the last jobs report in Australia also still be quite good. There's a case for the RBA to hike again, in which case I'd expect the 67.25.40 to come under pressure again to the top side. Of course, first of all, we have to go through the last day of this month. The models are saying that it's dollar selling, so we could already be there tonight before the RBA. But keep an eye on the RBA. I think the difference between raising and holding the hand still is going to be quite big for the Aussie dollar. Okay, if we start to get above 67.40 again, 67.60 is going to be a bit of a next level, but I do think that your bigger zone will be closer to 68, the figure. If in turn they keep the hands still and they start to be dovish again, then you have to look at 66, 20, 30, and here the 66, 10, 66, the figure zone. If 66 breaks, then I think we are going to go much lower on the Aussie. That is over the RBA. Monitor very closely and monitor that 95.5 on the Aussie and post RBA, whether we are above or below. You've done already the China. Makes not a lot to say. We're really trading along that descending trend line again, for as long as nothing changes or the data don't start to fall out of bed. It's very, very hard to fight an 11% currency, in my opinion. And for as long as we are not going above 17, 17, 10 on the dollar mix, I don't see the global picture change too much, but keep an eye on those data. Euro makes idem dito. We are hovering around this trend line. A little bit of a rebound this morning from this trend line, rather due to the euro. I think it's a bit to do with the month-end flows as well. But for as long as the bigger picture we are below 19, this still looks relatively bearish. That's it, Ryan, for me for the start of this month. Yeah, I'm really trading the clock. I'll see where things are at 4 p.m. As I said, we're expecting some more dollar sales. We're expecting a bit of currencies on the move, but then I think the August can be prepared once we are post those 4 p.m. fixings later today, right?
Thank you, mate. Still, I wanted to ask you quickly about stocks. Yeah. Obviously, seeing no one's selling anything up here at the moment. DAX, in fact, on its way. Well,
new all-time highs.
New all-time highs. Yep. Well, we did that last week, but it's continuing to even knock out those prior highs. So what's going on? The German economy isn't looking too hot, yet we're seeing their stock market all-time highs. We can't say this is the old QE trade, because there's no way QE is coming back. So what's the drive? Is it just a dividend drive, do you think? People parking their money where, if rates are going to start coming back down, if rates are topping out, is this money going into dividends? Do you think?
It's a good question. I think
I have a view, but go on still.
Go on.
Go on.
Yeah, I was just going to say, I think saying that QE is not coming back is a big statement. The market is now starting to expect looser conditions. Exactly how they're going to be. Is it going to be just rates lower, or more buying by central banks of various bonds and what have you? It's another question. But what we're seeing is the knee-jerk reaction of markets thinking that we're at the top in rates, and I actually agree with the fact that we are at the top in rates. Economic data is looking pretty weak again, more weak numbers from Germany, from pretty much everywhere. So with the Fed having made the first move and effectively, they haven't told this explicitly, but I think they're done for now. Every other central bank is going to follow. And we saw the ECB being very dovish, or not very dovish, but they were dovish. And I think the other central banks are going to follow. So this is the knee-jerk reaction of markets saying, oh my God, we're done with rates. Tightening is over. This means that risk is going to get bid. That is interesting, and in the short term, it does make some sense, but it ignores the fact that the economy is not going to be doing very well, and stock markets are linked to the economy. I mean, that's what they represent. So we are seeing used to, yeah. So we're seeing this continued push because tightening is stopping, but at some point there has to be a correction. Now, having said that, would I go here and short stocks? Of course not. And I've said this for a few months now, I think. No point in trying to short this market because you're going to get hurt. When we get technical evidence that there is potentially a turn, then we start looking at shorts, at levels, etc. Until then, I'm not even considering it. And I know it doesn't make sense because I think stocks are overvalued given the whole economic environment. But this is what we have. So that's my explanation.
Yeah. Okay.
Well, I mean, the biggest word to me, or the biggest reason for that, is underinvestment. If we look at the end of last year, the biggest call out there was 2023 is a recession year. Okay, and the further that gets pushed back, the more people are confident to invest in equity in equity assets, and you get a little bit of return on your stocks. And also, there's been so much money put into money market instruments. I think they're at record highs, right? $5.5 trillion. But there's still a lot of money in the system. I was looking at the balance sheets today, this morning, on the Fed and the ECB and stuff. We are still way above levels where we were before the pandemic, right? So there's a combination of a lot of money still in the system. Even if QT is running, we're still not at levels where it seemingly the QT is biting, because that was one of my risk scenarios as well, is that QT would start to bite at one stage and weigh actually on some assets because of the lack of liquidity and money to put at work. But there was not enough money put at work, and then if your indexes, it's like a self-feeding kind of system, right? Where you go like, wow, it's going up, but I'm afraid, but then it's going up, and I need to show return, so I need to get back into those assets, and that is partially, I think, explaining what there is now. It's the combination of the underinvestments, recession being pushed back. It's probably going to come, but we now, instead of saying that the Fed and the major central banks are creating recessions, people need to scale back on that. And then your interest rates are you're not going to put more than a certain percentage of your assets all in cash, right?
Yeah.
So yes, those money market funds have been attracting heaps of money, but there's still a part of the cash that needs to go to work in different instruments, because that is what your model, for one, tells you, and for two, that is how you sell your strategies to your investors. You don't want to be invested in one instrument, and I think that's where now this thing comes. Of course, you're going to have algos and model funds who just go like, it goes up, I buy, and I need to buy because that's what my model tells me. But I think there's a bit more behind, and so it's a mix of reasons why equity markets are up right now.
Yeah.
We are going to need really a downturn in the data for this to turn around, but then I think it could be violent.
Yeah, no, I agree with that. I think you need to watch for the signals. I don't like markets that go up too fast, too quickly. When they tend to go up without much of a pullback, like you see here, that's when I start to get a bit worried. But if you want to start picking tops, you've got to look for the price action that suggests, like this, that it isn't going to go much higher for a while, and then you might get your shorting opportunities. But at the moment, you're trying to pick tops, and we don't like doing that unless we've got evidence to say otherwise. Right, we're going to call that a day today. Nice early one. Got you all set up for the week ahead, I should hope. Be careful with markets this week. Another busy one. Not wise to marry a trade for too long in between the data points. We are heavily data dependent and data dependent trading, which is good for us because it means we should get some volatility around the main numbers. So have your sniper rifles at the ready. Thank you all for coming to the Flow Show. Thanks, Kay. Thanks, Dale. See you all tomorrow.
Thanks, chaps. Thank you, Ryan. Kay.